Traditional wealth management relies on a single, aging premise. You earn capital, park it in a static account, and wait for decades of appreciation. This strategy feels secure. An untouched balance looks like a fortress against market volatility, a way to preserve value by simply removing it from the field of play. This is the accumulation fallacy. Capital that is not moving is capital that is decaying. Inflation and missed cycle yields erode the purchasing power of idle balances every day they remain dormant. Capital is an engine designed for momentum. In the modern ecosystem, passive holding leads to a consistent, measurable loss in relative market position. Modern financial success is a function of absolute capital velocity. The goal is the rapid completion of capital cycles. Absolute velocity requires engineering every dollar for continuous, deliberate motion. It is a transition from observing market growth to driving execution frequency. Traditional behavior accepts long holding periods and low transaction frequency. Velocity-based behavior prioritizes weekly execution cycles and immediate reinvestment loops. Engineered liquidity is the direct mathematical result of these high-frequency systems. It is produced through design rather than being a state you wait for. Operating at high velocity requires a complete detachment from the emotional weight of individual capital units. System architects stop asking how long an asset should be held. They focus entirely on execution frequency, specifically how many cycles their system can complete within a 24-hour window. This shifts the growth model to frequency-based compounding. While traditional compounding depends on the passage of time, velocity compounding scales through the sheer repetition of successful cycles. Increasing the frequency of execution causes capital to scale without needing to increase the return of any single cycle. Efficiency comes from speed, not just margin. A velocity engine operates through three distinct operational layers that form a closed-loop system. The input layer deploys small, modular capital units into controlled entry points. This limits initial exposure while maintaining the ability to scale up through volume. In the execution layer, capital moves through high-frequency models, including platform arbitrage and automation-driven workflows that extract value in short, predictable bursts. The output layer captures immediate cash settlements. These funds are instantly redistributed back into the input layer to begin the next cycle without delay. The total efficiency of this architecture is measured by the time it takes for $1 to complete this entire circuit. High-speed execution is often associated with high risk, but systematic design provides a different outcome. Velocity systems use strict exposure limits and liquid reserve buffers to maintain stability. Every cycle is capped to prevent any single event from impacting the core architecture. Instead of concentrating all of your wealth into one single asset, modular capital is strategically distributed across multiple parallel systems. This architecture manages risk by distributing it across hundreds of controlled, repeatable cycles. Stability is achieved through diversification of frequency and position. Global financial infrastructure is moving toward real-time liquidity webs. The traditional model of passive, long-term ownership is becoming less competitive as settlement times drop. AI-managed capital and instant settlement protocols allow for the reallocation of resources at intervals that manual legacy strategies cannot match. When markets settle in milliseconds, the opportunity cost of holding a static legacy asset increases. Systems built for circulation capture more data and more yield than those built for storage. Move away from treating your finances as a static vault. Start by defining the specific liquidity targets your capital must hit to stay in motion. Segment your capital into operational tiers and apply automation to your repetitive cash flow processes to remove human friction. The most effective financial systems prioritize controlled circulation over the total volume of capital stored. Wealth in this era is a function of system design. Success depends on the efficiency of your circulation engine.